Welcome to the Deep Dive. Today we're jumping into the source material from the first quarter 2025 earnings call for AEO Inc.
Yeah, that's the company behind American Eagle and Aerie, of course.
And our goal here is pretty straightforward. Unpack that call, really understand the results, get management's perspective on why things happen, and see what they're planning next.
Exactly. We want to cut through, some of the corporate jargon and pull out the key insights for you, what actually matters from that call.
Think of it as getting the core takeaways on their performance and strategy, straight from the source, but without needing to listen to the whole thing yourself.
Right. And look, let's just set the scene up front. The main headline, it was, frankly, a disappointing first quarter for them.
Yeah, highlighted by an adjusted operating loss, which is never what you want to see.
Definitely not. So let's get into those numbers.
Okay, starting at the top, consolidated revenue. It came in at $1.1 billion for Q1.
Right, and that was actually a 5% drop compared to the same quarter last year.
And that flowed down to comparable sales, right? The measure for stores open at least a year and digital.
Yeah, exactly. Comps were down 3% overall for the company.
Okay, and breaking that down by the big brands.
American Eagle comps dipped 2%. Aerie was a bit weaker, comps down 4%.
So yeah, pressure across both of the main engines there.
For sure, but the real story, the thing that drove that bottom line loss, was further down the P&L.
You mean the adjusted operating loss?
Yeah, they reported a $68 million adjusted operating loss for Q1.
Which works out to, what, an adjusted loss per share of 0.29 cents?
That's the one. Pretty tough result.
And a huge piece of that was this massive inventory write-down they took, wasn't it?
Absolutely huge. They called out a $75 million write-down specifically on spring and summer goods.
Wow. Can you just quickly explain what exactly an inventory write-down like that means for the financials?
Sure. So essentially, it's the company saying, look, this stuff we have isn't worth what we thought it was. Maybe it's out of style. Maybe there's just way too much of it. It's not selling. So they have to reduce its value on their books. And that hits the profit margin directly and immediately.
Got it. So it tanks the profitability of the stuff they did sell.
Precisely. And you saw that clearly in the gross margin number. It came in at 29.6% for the quarter.
And the merchandise margin itself, the profit just on the goods.
That decreased by a massive 960 basis points year over year.
Whoa, 9.6 percentage points. That's a big drop.
It really is. And get this, 680 of those basis points, so 6.8 percentage points out of that near 10-point drop, were directly because of that $75 million write-down.
So a major hit reflecting real issues with the inventory they had on hand.
Definitely. It wasn't just some small accounting adjustment.
Okay, so beyond that huge write-down, what other reasons did management give for the weak performance?
Well, they were pretty upfront about it. They pointed squarely at product misses in some key categories.
Like what?
For Aerie, they mentioned soft apparel, specifically calling out fleece tops and shorts as not hitting the mark.
Okay. And similar story at AE?
Yep. For American Eagle, the culprits were shorts and pants. Seems like the assortment just didn't resonate with customers as they'd planned.
So getting the product right was a clear issue. And that was layered on top of cost problems too, right?
That's right. They mentioned that the merchandise, especially for Aerie, actually came in with higher design and transportation costs baked in.
Oh, okay.
And crucially, they said they weren't able to get the pricing they needed, the AURs, average unit retails, to actually offset those higher costs and keep margins healthy.
So the product maybe wasn't compelling enough to command the price they needed, given the higher costs. That leads to...
Exactly. It leads straight to more promotions, discounts, markdowns, trying to move that inventory that wasn't selling well at full price.
Which just puts even more pressure on the margins, even before the big write-down.
You got it. Bit of a downward spiral there.
Did they mention outside factors, the economy, weather, that kind of thing?
They did. They mentioned the macro environment, and they specifically called out the cold spring weather, particularly back in February, as headwinds.
Right.
But importantly, they were also clear that while those things didn't help, their own execution needed to be better. They took responsibility for the product misses and the cost issues.
Okay, makes sense. Now, diving into the operating expenses side, they mentioned buying, occupancy, and warehousing costs deleveraged. What does that mean for us?
Yeah, deleverage sounds fancy, but it just means those costs became a bigger percentage of sales. because sales went down, right?
Right.
And a lot of those costs, like rent for stores, occupancy, or running warehouses, are relatively fixed. They don't drop just because sales do. So when revenue falls, those costs eat up a bigger slice of every dollar that comes in.
Gotcha. So lower sales made those fixed costs way heavier.
Right.
What about SG&A, the selling, general, and admin costs?
Interestingly, SG&A dollars actually went up slightly, up 2% compared to last year.
Why was that if things were tough?
Primarily because they invested more in advertising, trying to support the brands, maybe build momentum for later.
Okay.
That increase was partly offset by lower spending on compensation in other areas.
So pulling it all together for Q1, product didn't hit, costs were up, promotions ramped up, big inventory write-down happened, and fixed costs hurt more because sales were down. Pretty challenging picture.
That sums it up well.
But were there any green shoots, any positives they pointed to amidst all that?
Yeah, there were a few bright spots, and management definitely wanted to highlight them. One key thing was traffic.
Traffic.
Yeah, customer traffic was actually up across both brands and in both the physical stores and online.
Huh. That's interesting. So people were showing up, coming to the site, but sales were still down. What's that tell you?
It suggests the brands still have drawing power, right? People are interested. The problem wasn't getting eyeballs or footfall.
It was converting them.
Exactly. The lower prices from promotions didn't make up for maybe fewer people buying or people buying less overall because the product wasn't quite right at the price points they needed. The conversion wasn't there, even with the traffic.
Okay. What about specific parts of the business? Like offline by Aerie?
That was a positive call out. They said offline showed positive growth and is still gaining market share. They seem really bullish on that concept.
Good to hear. And Aerie's core intimates business, that's so important for them.
Yeah, they said Aerie Intimates actually saw improvement during the quarter compared to the previous one, and significantly it gained market share in the category, even while the overall intimates market has been a bit tough.
What do they attribute that to?
Newness. New fabrics, new designs, and they felt their refreshed marketing was hitting the mark there.
Okay, a definite positive then. Anything similar over at American Eagle despite the overall negative comp?
Yeah, a few things. In women's, they saw growth in areas linked to that social casual dressing push they have. Fleece apparently had its best quarter ever.
Really?
Wow.
Yeah. And women's denim bounced back. Remember last quarter they had out-of-stock issues?
I do, yeah.
Well, they said once they got back in stock, the denim business saw significant improvement in growth. So that's a core strength showing resilience.
Okay. What about the men's side at AE?
Overall pressure there, but they did call out men's tops and their 24/7 activewear line as bright spots performing positively.
And the digital channel performance overall.
Also saw an uptick during Q1. Another signal, maybe, of that underlying customer engagement, even if the sales value per visit was pressured.
All right. So definitely some areas of strength beneath the surface, but clearly overshadowed by the big operational misses in Q1. So what did they do immediately, like right after the quarter ended?
Well, the most immediate and impactful thing was taking that $75 million write-down. That wasn't just accounting. It was a conscious decision to clear the decks.
Right, to get rid of the underperforming spring-summer stuff.
Exactly. To get the inventory cleaner, as they put it, heading into Q2 and, more importantly, into back to school.
And how are they trying to fix the root cause? The product issues and the cost stuff.
They talked about putting much more rigor into the buying process, more cross-functional work between design, merchandising, planning, trying to get everyone on the same page earlier.
Makes sense.
And interestingly, they said they've deliberately left their buys for fall and holiday more open than usual.
Oh, why that?
Flexibility. It lets them react faster to trends and what customers are actually buying, rather than being locked into decisions made months ago that might turn out to be wrong again.
Okay, learning from Q1, what about bigger operational changes? Supply chain.
Yep, they're speeding up plans there. They mentioned consolidating their fulfillment network.
Right, closing 2 fulfillment centers.
Exactly. That came with a $17 million charge in Q1, a non-JAP one, meaning sort of outside normal operations cost.
But it saves money long term.
Supposedly. They expect about $5 million in annual savings from that. So an efficiency play.
And are they still moving sourcing away from China?
Absolutely. They said they're on track to get China sourcing below 10% this year, and even down to low single digits for fall and holiday. Diversification is still a key strategy.
What about tariffs? That's always a worry in retail.
Yeah, they're actively working on it, working with vendors, shifting production where they can. They did say there's a couple $1 million of tariff impact baked into their Q2 guidance.
Okay.
And the full year hit could be around $40 million, mostly landing in the second half, Q3 and Q4. So it's definitely on their radar and impacting plans.
Okay, let's shift to capital and cash. How's the company looking financially despite that Q1 loss? Are they okay?
Yeah, they seem to have decent liquidity. They're still returning cash to shareholders, too. In Q1, they kicked off a $200 million accelerated share repurchase program.
An ASR, buying back a chunk of stock quickly.
Right, and they did another $31 million in regular open market buybacks on top of that. Plus, they paid out $22 million in dividends.
Okay, so they're still acting like the long-term picture is solid. What's the actual cash balance?
They ended Q1 with about $88 million in cash and investments, and they have over $620 million in total liquidity if you include their credit lines. So, yeah, they have flexibility.
Did the tough quarter make them rethink spending plans, like store openings or remodels, capital expenditures?
It did. They lowered their full-year CapEx forecast to $275 million.
How are they cutting back?
Fewer AE remodels, for one. They were aiming for maybe 100. Now it's more like 60 to 70.
Okay.
And Aerie openings, they're planning around 30 now, maybe trimming that back a bit from initial thoughts. Some tech spending got shifted too. They explicitly linked these adjustments to the Q1 performance and those tariff worries.
Right, tightening the belt a bit where it makes sense.
Uh-huh.
Because what about the outlook? Did they give guidance for the full year?
No, they paused annual guidance for now.
Why?
They pointed to the near-term uncertainty, the macro picture, those tariff impacts we just talked about. They want more visibility before putting full year numbers out there.
Fair enough. But they did guide for Q2, the current quarter.
Yes, they gave specific targets for Q2. They expect revenue to be kind of similar to Q1, down about 5%.
Okay.
And comparable sales, all similar, projected down around 3%. Still feeling some pressure there.
So continued top-line weakness expected in Q2. What does that mean for profit? Are they expecting another loss?
No, they are guiding to an operating income for Q2 in the range of $40 to $45 million.
Ah, okay. So back in the black, operationally speaking, that's a step up from Q1, but still down from last year's Q2, presumably.
Exactly. A positive step, but still reflects the ongoing challenge.
And what's driving that Q2 profit number? Margin pressure still.
Yeah, they expect gross margin in Q2 to be down year over year again.
Why this time? Still the write-down hangover.
Partly needing more markdowns, they said, to clear through the rest of the seasonal inventory before back to school really hits. Getting clean, right?
Right, that clean and mean focus.
And also that same deleverage issue on buying, occupancy, and warehousing costs because the comps are still expected to be negative.
Makes sense. What about SG&A spending in Q2 and beyond?
They expect SG&A dollars to be roughly flat in Q2 compared to last year. And actually, for the full year, they're thinking flat SG&A overall, too.
How are they managing that if they're still investing in advertising?
Offsets. They mentioned keeping ad spend up, especially for back to school in Q3, but finding savings elsewhere, including in compensation.
Okay.
Anything else on the outlook?
Just that they expect currency headwinds, which have been dragging a bit, to ease up in the second half of the year as they start comparing against periods last year when those headwinds were already there.
Got it. So stepping back from the numbers, what was management's tone, their view on the customer, the economy?
Well, they acknowledged some of those macro things early in the year. Immigration shifts, government spending, tariffs might have played a role. But they sounded, I'd say, cautiously optimistic that maybe the worst of that specific impact is settling down. They even mentioned hoping for potential legislative action, like a tax plan later in the year that could boost the economy. Interesting. It sounds like despite the rough quarter, they're really focused on what they can control now.
Absolutely. You heard the word urgency a lot. They are laser focused on reigniting performance. And the big target is back to school.
Their Super Bowl, they call it.
Exactly. Getting clean and mean for that is the immediate priority, making sure that inventory is right.
And the new back-to-school stuff is hitting soon.
July, they said. And they're planning big marketing campaigns around it, too, trying to really elevate the brands and connect with customers for that key season.
So even though they paused the full-year guidance, they still sound confident longer term.
Yeah, they definitely reiterated confidence. Confidence that things will improve as the year goes on. Confidence in the brands themselves and in the strategies they have in place. They feel they're making the right moves now for a better second half.
Okay, so let's try and synthesize this. What does this deep dive tell you, the listener, about AEO right now?
Well, first, Q1 was clearly an operational miss, big time. Product assortment issues, cost control problems, leading directly to heavy discounting and that massive write-down.
And while they acknowledged external factors, they really owned the execution issues.
Right. But importantly, the call also showed there's underlying brand appeal. Traffic was up. Specific areas like offline, Aerie Intimates, AE Denim, AE Fleece, they showed real strength.
Which suggests maybe if they fix the execution on product and cost, the customers are still there, right?
That seems to be the implication. The demand signal isn't totally broken.
And the actions they're taking, the inventory reset, changing the buying process, tweaking the supply chain, adjusting CapEx, show they're reacting fast.
Definitely acting with urgency. The paused guidance signals caution, sure, but that Q2 outlook gives a concrete target.
Continued sales pressure, but getting back to operating profit, even if it means taking some margin hits now to clear inventory for back to school.
Exactly. Q2 looks like a cleanup and reset quarter, getting ready for that critical Super Bowl.
Okay. Now, just a reminder, everything we've discussed is based on the company's public statements for informational purposes. This is definitely not financial advice. Don't run out and trade based on this.
Absolutely not. But, just as a fun thought experiment, based purely on their commentary, what kind of wild idea pops into your head?
Okay, here's a totally speculative high-risk thought. Tanafa, this is not financial advice.
Go on.
Given the extreme urgency they expressed, the massive write-down supposedly leaving them clean for Q2, Q3, the intense focus on back to school as make or break, and their stated confidence, could they be setting up for a bigger rebound in Q3 than people might expect?
So you're thinking if the new back-to-school product actually lands well and the clean inventory means less discounting on that new product and maybe the consumer holds up, could that combo lead to a surprise earnings beat in Q3?
Potentially. It's a massive if on execution, of course. I bet that they can actually turn it around that quickly and the customer responds immediately. Purely hypothetical, based on connecting their dots.
It's an interesting scenario to ponder, for sure. Shows how you might try to read between the lines of what management is signaling while fully acknowledging the risks.
Exactly. Just an exercise in thinking about possibilities based on the info given.
Right. Proper investment decisions need way more research and risk assessment.
Okay, so that wraps our deep dive into AEO's Q1 2025 earnings call. A really tough quarter operationally, leading to rough financials.
But also a quarter where management seems to have reacted swiftly with corrective actions, and they've put a huge focus on turning things around for back to school.
You've got the key numbers, the reasons management gave, the actions they're taking, and their outlook for the near term.
So the final thought we'll leave you with is this. They're making big, fast changes after this stumble product, inventory, supply chain, spending. They sound confident, and they point to strengths like offline and denim. The question is, how quickly can these fixes really start showing up in the results? Can they gain traction fast enough for a strong back half, especially with back to school and the holidays coming up? Something to think about. As always, we encourage you to check out the source material yourself.
Thanks for joining us for this deep dive.
We'll catch you on the next one.